Hey guys! So I told you I'd make you a quick video series with a presentation to recap what we should have gone through in class. Um, so basically, we're looking at business, which is essentially an investment agency. Their role is to raise funds and invest funds and make sure that all the money balances out or makes profit. So investors, they're fundamentally analysts, that's the word. They scrutinize financial statements to see if a business is worth investing in. So, an accountant is somebody that is in charge of keeping the records of everything, creating those, the cash flows, the balance sheets, and all those sort of things, and then providing an analysis that they can give to their manager. They're primarily involved with quality, the relevance of the information, and making sure that everything they do is done in a timely manner. So they're analysing whether the business is actually making a profit, where things aren't getting the right return from, etc. A finance manager, in comparison, they don't provide the account information, but rather they make decisions based on that data. So if the accountant says to them that, hey, we're spending all this money on marketing and actually it's not reaching people, we're not getting any more people paying for our service, it's the finance manager who is in charge of actually making that decision to change the marketing strategy based on the stuff that the accountant does. In some small or medium companies, so you're looking at thousands of employees rather than hundreds of thousands, the accountant and the finance manager can be the same person. Types of investors. So the main one that we're focusing on in class is shareholders. They're aka the owners of the business. So shareholders can be the directors, the people that own the business, but it can also you can sell the shares out to get that initial investment, but actually then the more that those same shares are sold, it doesn't actually affect the business. The only way it affects the business is they have to keep paying dividends. So essentially you want to put your shares on the market to get that big investment at the beginning, but the more of those shares you can retain for yourselves, the more control you have over the company. The long-term lenders, that's like your banks giving you loans and stuff like that. And then there's short-term finance, such as your credit cards, your overdrafts, etc. Services on credit is where, say you're giving another company is giving you a service, and you're going to pay for it once the service is complete rather than at the beginning of the service. That's those kind of services on credit, so that you can be seeing the financial benefit of those services before you actually start paying something back. So then, a financial asset is all the things that we've talked about in class, your loans, your shares in other businesses. Compare this to your real asset, which is your land, your building, your plant and your inventory. And sometimes people include the training of their employees as well, if it's a sort of workshop-based company. So the people that are employed to manage assets, it's crucial to have at least one person in a company that is there to monitor the sort of time and quality of investments. And so what they're monitoring then is the operating costs, which is the wages, the raw materials, everything we covered in Percy's class. And then they're looking at the surplus money, which is remaining after tax, and that's the sort of stuff that they're going to have to pay back to investors or share out in dividends for their shareholders. To make the financial decisions, they can't predict the future, but they're there to estimate what is the most likely response to things. They tend to do this by quantifying the data that they have through percentage estimates of the future. This is where all our maths equations are going to come in. And so what they're measuring in all those equations is essentially they're looking at risk. For businesses to want to invest in a company, they first have to have a risk-free amount. So this is what they're definitely going to get back no matter what. And so they know that if they hand in £10,000 and they know that the way that the company is running, they'll definitely get that £10,000 back within 3 to 5 years. There's no risk there associated with getting their money back, but then they've got to decide if they invest. The more they invest, the more risk there is. So if they invest 12,000, say that's here, then 12,000 might mean that there's more risk involved, but it means that they're should that risk pay off, they might get 15,000 back rather than just their initial investment. And so by here, where they're spending £20,000, there's way more risk involved. But should that risk pay off, then they're looking to get a greater return. It could be up to like £40,000 they're getting back. And so financial decision making is based on finding a balance between these two things: how much you want to be risk-free and how much you're willing to work with risk to increase the chances of getting a big payout at the other side.